Happy Friday. I hope everybody's having a great finish to their week. University of Utah is playing USC this weekend, so go Utes, but we have a lot to cover in this video, so let's get started with this week's credit update. This week we're going to be talking about two articles, one from NPR and one from Axios, the first one talking about medical collections. The big thing that we wanted to highlight here with medical collections is that there have been a lot of new policies coming out that are protecting consumers. One of them being that paid medical collections now have to be removed from the credit profile, and that starting at some point in 2023, medical collections under $500 will not be negatively impacting a credit score and cannot report to credit. So those are really important positive improvements, but one of the big things that we're seeing with medical collections is that for those accounts that have higher balances, consumers need to take action and actually validate that information with the creditor beforehand or with the credit bureaus before they resolve the accounts, because we come across medical collections all the time that have inaccurate reporting where the balances are incorrect, or it was paid by insurance, or it was a medical billing issue or a coding issue that led to that account being put on the credit report. So make sure that if you're working with clients who have medical collections, that they validate the information both with the credit bureaus and with the creditor before seeking a resolution, because there could be a chance that this account is inaccurate and it shouldn't have to be paid. Now, the second article here from Axios talking about credit scoring is really highlighting a new change in credit scoring, which is this really expansive perspective on how these companies are using credit scoring and pulling in non-traditional credit line items like rental payment history and utility payment history to help young consumers populate credit scores. The big thing that I want to highlight here is, yes, rental payment history and utility payment history can help credit invisible consumers populate their scores. But there are established processes like building out a secured credit card and using it correctly, or opening an installment loan and paying it on time. These are other things that you can do to not only help you populate a score, but to build your score to a point where you're getting better interest rates and maximizing your purchasing power. And in this market that we're in, it's not good enough just to have a mediocre credit score. You really have to work to do the other things to build your credit score to a point where you can maximize your purchasing power. And talking about purchasing power leads me to our client success story, which is a client came to us a couple months ago. They're in the high 600 range. They're trying to qualify for a home, and we were able to successfully see their scores go from a 694 to a 724 in a very short period of time, getting them into a position to not just qualify for their home, but get a better interest rate so they could afford the home that they want. And we love those types of stories because we love seeing families succeed, save money, and build healthy credit along the way. So for all of our referral partners, thank you so much for everything that you do. We hope everybody has a wonderful weekend. Go Utes, and we'll talk to you next week.